We are back in the studio. I'm back with my boy GC, and some stuff's going down, man. Mortgage rates have dropped. We're going to talk about that. There is some news in the economy, right? Consumer sentiment is down. Builder sentiment is down. I'm going to ask old Genius Concepts over here to tell me what he thinks about it, and I'm going to ask the dumbest questions in the room so we get to the bottom of it. Welcome, everybody, to the weekly edition of the Not Your Average Investor Show. I'm your host, Pablo Gonzalez. With me, as always, a man that I affectionately like to call GC, because he's got the genius concepts, because he knows how to generate cash flow, because he's a great co-host, and his name is Gregg Cohen. Say hello, Greg.
Yeah, man.
You like that?
I'm ready to talk about the economy today.
I'm so ready to talk to you.
Man, I've been excited since I rolled out of bed today.
Dude, I've been excited since you canceled on me running. I just started working. I've been a beast. I've pulled in a full 8-hour workday before this call. Let's go. I haven't even opened this thing. Let's go. We got some breaking news, GC. What you got going on?
We do have some beautiful breaking news. I wanted to share some really wonderful news on the JWB Rentals home side of the business here with you all. We just got out of a Tuesday morning meeting, which is where we share different departments, share their stats and how they performed over the past week. But it has basically just been a love session for JWB Rental Homes and leasing your properties out recently. Our previous world record for the number of homes that we rented out in a single week prior to this year was 53. And
single month world record 53.
Single week.
Single week. My bad.
Yes. It was 53. And then 2 weeks ago, we rented 51 homes.
Okay.
And we were like, oh, we were so close. And then 2 weeks ago, we rented 52 homes. And we were like, are we ever going to push through this glass ceilings here? And then last week, we rented 73 homes.
Whoa, let's go. 50%. 50% more.
Yeah, just crushed through that ceiling.
Wow. Wow.
Yeah, so we have rented 176 homes in the last 3 weeks. By far the most that we have ever rented in a 3-week span here at JWB. We've talked a lot about how this is a time where we're going to take some big steps forward, and we're going to talk a lot more about the rental home market next week when we do the market update. But guys, I want to share that great news with you. Many of you are getting calls from our teammates saying, hey, guess what? That home is rented.
Got a new resident.
And we're really excited about it. Share a stat with you. Overall, JWB has rented 26 more houses than we did last year at this time.
Okay.
So just
year over year, up 26 houses.
Up 26%. Up 26%. So I think it's about 100 more houses so far this year.
I forget that your population size is so significant.
Yes. So lots to be excited about and just big victories for our entire community.
Very cool, GC. For everybody that wasn't at TMM this morning, that is everybody on this call but me and Greg. Greg gave a little preview of the real estate market update and talking about rents and talking about how the market's doing. And I gotta say, man, I think it's the best one I've ever seen you do so far.
Ooh, really?
Yeah. You were bragging about like having ChatGPT as a thought partner, and I think it's really leveled you up.
Yeah, man. I tell you what, I put these slides together now, and I'm like, hey, ChatGPT. Try to label it this way. Can I do it any better? And what do you know? Yeah. We make quite a team. The three of us, me, you, and ChatGPT.
me, you, and GPT.
Quite a power.
GCPT, we're gonna call it, baby. GCPT. All right, GC. Speaking of things that are going on in the world, right? So, mortgage rates over the last 2 weeks have gone down. They're now down to 6.63%.
You seem so sad about this. You seem so somber.
I'm not good at numbers, so I'm reading my notes.
Okay.
I don't know if you've noticed. Down to 6.63% on March 6th, so a lot of sixes there. And I don't know what that's about. But it's the 7th consecutive weekly decline, representing the lowest level in over 2 months. I haven't heard that the Fed dropped rates.
Right.
So I would love to ask you, what's going on with interest rates? Why are we getting these drops?
Well, it's a great time for us to reinforce what we have been teaching about on this show, especially over the last 2 years, about how our 30-year mortgage rates come to be. And it may be somewhat affected by the Fed cutting the Fed funds rate, but there's a whole lot more to it than that. And over the course of the last couple of years, we've talked about how rates have gone up, even though the Fed hasn't raised the Fed funds rate. And now we have an example where the interest rates for all of our mortgages has gone down substantially, about a half point, even though the Fed held the Fed funds rate steady. And the reason is because the most correlated to our 30-year average interest rates is actually the yield on the 10-year treasury. Because at the end of the day, what drives our mortgage rates are just investors on the other side of the table. And there's an investor on the other side of the table, and he or she is saying, you know what? I could put my investment in mortgage-backed securities, or I could put it into 10-year treasuries. And over time, there typically is a certain spread between those. And they basically say, well, the risk is commensurate with that spread. And so if we want to know what's going to happen with our interest rates, we need to look at what's happening with the 10-year treasury yield.
Got it.
Not so much what the Fed funds rate does.
So what I'm hearing is people out there with a decision to invest their money, right? Like us here, we all by de facto invest in rental properties or strive to invest in rental properties, or else we wouldn't be having this conversation here. But folks out there, they just look at their pool of money and they look for safe places long-term to put their money. And they compare real estate investing to bonds, right? And when bonds are looking really attractive, they're ticking up in their returns, then that makes people go there. And therefore, the real estate market lowers interest rates in order to make it more attractive for the people that are making that decision. Is that?
I think you're on the right track. Let me kind of synthesize. So when the 10-year treasury yield goes up, our interest rates on our 30-year mortgages go up.
Okay.
When the yield on the 10-year treasury goes down, our mortgage rates go down. And the yield is inversely related to the price.
Okay.
So when the yield on the 10-year treasury goes up, that means that less people are buying.
Got it.
So there's less demand for it. So what's happening right now is the opposite.
Yeah.
Right. The
Demand
yield
is rising
on the
for it.
10-year treasury is down.
Okay.
Demand for the 10-year treasury is up. And that's why our mortgage rates are down.
Got it.
Does that make sense? There's a lot of up, down there. But long story short, 10-year treasury down is a good thing for lower interest rates.
Okay, got it. All right, sweet. So interest rates are lowering. What's it look like right now for investors? What does that mean for us who choose to put our money in rental properties?
Well, it's a great thing for us, right? It's a great time to buy when interest rates were about a half point higher. But now when we look at interest rates being a half point lower than what they were, call it 2 months ago, you instantly can see the benefits of this day one. What this means is a lower interest rate on your mortgage that you get. You didn't have to buy the rate down as much to be able to get that lower interest rate. And it's more cash flow in your pocket, day one. More cash flow in your pocket because the rents and all the other expenses, revenue, and everything else is the same today as it was 2 months ago. But now your interest rate is lower, your monthly payments are lower. And so more cash flow day one for your rental properties, better return on investment, all that good stuff. This might allow you to be able to put less down as well and still get positive cash flow, which is a great way to increase your return on investment for all 5 profit centers. So a great thing for all of us in the community. I think that's why I was making fun of you for being so somber out there. I mean, we've been waiting a long time for some good news on the interest rate side. Sure. Let's give a few high fives out there.
Let's take a beat. Let's take a beat.
Use this right now, right?
Okay. So is there people out there right now? Oh, so what is the rate that folks are closing at today at JWB, and like what's that looking like?
5.25%.
5.25%.
Yeah.
Okay. Is it, before we expand and talk more about the market, does that mean it might be time to refinance for people? Like, is that like so I think of somebody that's like thinking about buying properties, like, I'm just waiting for it to go a little lower so I have a little bit more cash flow and I can put a little bit less down. That's a trigger. Another trigger might be, like I've been meaning to, like myself, right? Like I've been meaning to refinance and pick up another JWB property. Right. Is that something right now is the time to like go poke at that? Like go to chatwithjwb.com,
Definitely.
set
You
up an
should be
appointment.
talking with experts right now,
Yeah.
especially if you're sitting on a lot of equity in your real estate, in your rental properties, in your home, in your primary home. You should be talking with those who you trust and who have been here before to navigate this, because this is a great time to potentially both unlock a lot of equity. As a country, we have trillions of dollars of equity sitting in our real estate right now, and also potentially lower your payments. Now, that's dependent on what the interest rate was ahead of time. But I remember in our conversations for that third property that we highlighted last time.
Katina.
Yeah, Katina. Your interest rate, I think from my memory, is like 5.75%.
Okay.
So
right now I would be looking at dropping my interest rate.
you could,
if I was
right?
to refinance.
Yes. We need to take a look at it, because we would have to look at what is the rate buy down points and things of that nature. But yeah, this is the time to strike open that conversation.
Yeah.
So for new clients, for current clients, reach out to JWB, set up some time to sit down with your portfolio manager, and we can lay it out for you and say, listen, these were your interest rates on your previous properties. This is the amount of equity you have sitting in your properties. These are your goals to be able to get to that place you want to get to financially. This is how we can use all of our resources here and add more properties to your portfolio, or refinance and get that capital out for you, which, by the way, you don't pay taxes on it when you take that money out and refinance, and bring the capital in. So, and maybe it's refinancing the capital for you to do other things.
Yeah.
But you should be able to have that conversation right now, because this is a wonderful time to be able to use the resources that you have.
So if you haven't talked to your portfolio manager in a while, this is a good time to take your portfolio manager's call and be like, oh, I'm happy you called me. Let's, why don't you do some homework for me?
I'd say just be more proactive. Send us a text right now, 904-293-0341. That's our text number, 904-293-0341. And for a new client or a current client, just reach out to our team. Our team's going to be there to respond to you. It's a person on the other side. And we're happy to set up that phone call for you and start to put the numbers together for you.
Cool. Sounds good. And if you're listening on the podcast, go to chatwithjwb.com and set up an appointment also. That's another way to do it.
Perfect.
All right. So a couple of things. Andrew Barnhill, the ringmaster. I don't know did he check in earlier?
I think he was a little late to the game.
Yeah, it's a little late to the game. A couple people checked in late. You know who checked in late? One of our favorite names to pronounce, Aaron O'Neill. Into that night. I'm
just gonna be like hanging out with you like during the week, just throwing a random Aaron O'Neill and see if you catch it.
Yeah, for sure. I'll catch it. Jamila Bonahum is asking, in general, how many points lower before you refinance?
In general, how many points lower before you refinance? I think she's asking when is a great time to refinance?
Yeah, at what point would like the rate drop? Yeah.
That is there are so many things that go along with that, that thinking. For example, it might make sense for you, based on your goals, for you to refinance, even if the rate is the same. You could even make an argument, and if you actually run the numbers on it, you can make an argument that it would make sense to refinance, even if the rate was slightly higher, because you're going to pull out all that equity and make a good investment with it. So it's not a one size fits all. I don't know. Whatever.
Right.
It's not one size fits all for everybody. Reach out to us, Jamila, and we'll have that individualized conversation with you.
You know what they say? You can get a good look at the size of a T-bone.
Yes.
All right. So then let's move on to the greater economy, right? The greater economy. What we're hearing right now, there is a consumer confidence report that is basically saying it's at like a real low. There's a builder confidence report that's at a real low. And Ringmaster Drew Barnhill is putting in here in reaction to what we're saying. Stock market has been sucking. Stock market has been sucking up all the capital. As the market sells off, bonds will get paid and bring down rates, right? So there's just like a bigger picture of all these things that are happening around us. Tell me, when you're thinking about like the consumer sentiment being low, from the brain of a real estate investor, what is pinging for you?
What I am rooting for as a real estate investor is I want lower interest rates.
Yeah.
Right. I think our entire economy wants lower interest rates. So it's not just from the lens of a real estate investor, but if I'm just looking from the lens of a real estate investor, I want lower interest rates. I have been rooting for bond yields to go low for a while here because that I understand that's what truly drives our interest rates. When the Fed lowers or raises the Fed funds rate, sure, it's a part of it. But as you've seen, it's not correlated with what actually happens to our interest rates.
Yeah.
So I've been rooting for lower bond yields. And when I say I'm rooting for lower bond yields, that means that I'm rooting for more people to make the decision to invest in bonds, specifically 10-year bonds. Because if you have more demand for 10-year bonds, then the yield goes down because there's more demand for it. We've all been rooting for it for quite a while. I think a better question is like, what does that mean? You're rooting for 10-year bond yields to go down. We have to look at why do those bond yields go down? Why do people decide to buy more 10-year treasuries? And the reason is because people become a little bit more scared in this economy. Now, I'm not rooting for people to be scared, but I understand that when people are feeling really good and really opportunistic, they put their money in the stock market. When they're a little bit more conservative, they're going to take a little bit of a pause. They want a little bit more of a safe haven. They're going to go to the debt instrument, which is a 10-year treasury or any type of treasury. So the things that are driving yields down are the things that are scaring people in this economy. And there's certainly some things to scare people in the economy. We can kind of go through a number of them, but when you start to understand these 3 or 4 things that are giving people some pause, you understand why money, like the ringmaster was mentioning, that why people are taking money out of the stock market, putting it into bonds, and how ultimately that's a very good thing for our interest rates.
People are doing that. They're putting money into bonds. You hear reports of like Warren Buffett is sitting on a ton of cash. You're hearing like fears of a recession, stuff like that. Like what's driving that? Like what are people pointing to that is giving them such fear, right? Like I have to assume that the political news cycle right now is just bludgeoning all of us, right? And we are bludgeoning each other from it, and that can't be fun, right? Like the war stuff, everything else, the tariffs, like nobody knows what's coming with any of that stuff, and it feels very uncertain on whatever side of the coin you're at. What else? Like what are the economic indicators?
Well, I think there's a combination of like the feels that we feel as an economy, which really does have an impact on where people put their money. And then there's certain economic indicators, and they're all painting a picture right now for a lot of folks and just saying, I'm going to pause. I'm going to pause. And a pause means I'm going to put it into a debt instrument, like a 10-year treasury. So, I mean, we'll just talk about the feels a little bit, right? When people are scared or people don't understand what's going to happen today, tomorrow, the next month, 6 months from now, they don't make decisions. If they're lucky, they put it into a very safe, debt instrument. Sometimes they just put it under their pillow.
Correct.
People hoard cash. People go to very safe investments in times of uncertainty. And between the wars out there, between the trade war, between the tariffs that we were talking about, just an incoming presidency creates a whole lot of unknowns. I mean, that seems like we don't even talk about the fact that it's an incoming administration. So much there. And I think people are just they just don't know. And when people don't know, they don't take opportunistic chances.
It feels like out of all things, real estate is the most emotional asset class, right? So I feel like
we think we know it because we live in one. We think we understand it.
Yeah, correct. And so it would make a lot of sense that we overcorrect for emotions in this asset class as investors, the same way that we, overcorrect for emotions with the way that we talk to property managers or whether you're residents or whatever, right? So that part of it makes a lot of sense.
And people get stuck in the feels a lot. But as a not your average investor, that's why we are here to help you make good decisions when things become a little bit uncomfortable. Which for real estate investors, especially for the last 3 years of interest rates have been elevated, it's been uncomfortable for us to make these types of decisions yet. There's a reason that we collectively have generated over $307 million in the times when interest rates were high and the times when interest rates were low. It's because we can kind of navigate that. So maybe now is a good time to talk about the objective things that people are seeing. And
although The Maven says that stuck in the fields is a great description.
Yeah.
I like it. I like it. Stuck in the fields.
Yeah.
Don't get stuck in the fields.
Yeah.
I like it.
It's
So yeah, so
why
let's
we're all
talk
here.
about let's unstick ourselves from the fields. Let's talk about objective data.
Well, so the objective data is also painting a picture of uncertainty as well. And that's really why bond yields are going lower. And that's why our interest rates are going lower. So a couple of things. Inflation is the headliner. We have been talking about inflation for a long time. Inflation is something where when inflation is high, people don't want to lend money out.
Yeah.
So if inflation is high, that's actually something that is going to drive bond yields higher.
When inflation is high, people don't want to lend money out.
Yeah, it kind of goes back to this inflation hedging profit center within real estate. You know, if you lend money out to somebody today and then inflation is raging, by the time they pay it back to you, your purchasing power is a lot lower for that same amount of dollars.
So it's the opposite of what we do when we borrow money to invest in real estate that keeps up with inflation.
You want to be a borrower during inflationary times.
Got it.
Yeah.
Got it.
So now these big money managers and people who are controlling hundreds of billions of dollars to potentially put it into mortgage-backed securities, they're watching the CPI. And there's the consumer price index, which measures inflation, is the easiest headliner measurement of inflation. And if they see inflation at, 6% or 9% like it was, they don't want to lend money out. They don't want to invest in bonds or mortgage-backed securities as much because they realize that the money they're going to get back in 7 years or in 10 years or whatnot is going to be devalued a lot because inflation would have eroded it. So does that make sense?
Yeah.
So long story short, when inflation is high and raging high, that's a bad thing for our interest rates.
Yeah.
That inflation high is likely going to lead to higher interest rates.
Correct.
Right. Yeah. And it also leads to a higher Fed funds rate, which is a contributing factor to it as well. So what's happened with inflation lately? Inflation actually is around 3% and it's gone down over the last, I think I put the chart up. I don't know if you want to put that chart there, but
yeah, let's do it.
Yeah. All right, cool. So like inflation, well, we'll bring it up. Hey, what do you know? Look at that beautiful CPI over the past 12 months. There we go. Pretty good from memory, right?
Yeah.
So 3.8% is what it was. You can see it's come down. And so when you look at this and when big money managers are looking at this, they're saying, okay, well, I'm seeing some stability over the last few months. I'm seeing it come down. Now, when I put all this money into something, it's not going to get eroded by inflation. So it makes more sense for me to invest in bonds.
To lend.
That's right. Yeah. Or to invest in mortgage-backed securities as well.
Got it.
So that's a good thing for our interest rates. It's a good thing for the economy that our inflation seems to be somewhat in check and hopefully goes down a little bit lower. But this is one contributing factor as to why bond yields have gone down. They've been allowed to go down because inflation isn't eroding the money.
That sounds like good news though, right? Like so why is that making consumer sentiment worse, right? Like this feels like the silver lining of things, right? Like inflation is down because people aren't spending money and people are like lending and they're doing this stuff.
People don't get this.
People don't get this. So that's part of it.
But I'm really looking at it from the lens of a real estate investor right now. And what's allowing our bond yields to go down, what's allowing our interest rates to go down. This is something that's allowing it to go down.
Got it.
If inflation had roared back up to 4% or 5%, our bond yields would be higher than what they are today.
Makes sense.
And our interest rates would be higher than they are today.
Got it. Okay. So then let's talk jobs then.
Yeah.
Right?
So that's not something that really scares people.
Yeah.
This is something that starts to make people a little bit uneasy. And it's the jobs report. So every month, the country releases the number of jobs that were added into the economy. And the thing about it is it's not so much about what the number of jobs added is. It's not the number, if the number increased from the previous month or is down from the previous month or what, it's less about that. And it's more about what did we expect that number to be and what did it come in at? So
did we meet expectations is more important than the overall number.
Exactly.
Okay.
Exactly. And so what happened in February's jobs report, we added 151,000 jobs, but that was below the expectation. We expected to add 170,000 jobs. And so when that happens, people are like, oh, is the economy constricting?
Yeah.
Are people losing their jobs more? Are we headed towards a recession? That's why you're starting to hear more about is a recession on the brink, right?
Yeah.
And again, on top of the feels, right?
Yeah.
People are scared about what is happening with the wars in the world and our, what that means for us here at home. And then people are concerned about the tariffs too. So you have a bedrock of feels. Like, I don't even know if you can have a bedrock of feels, but you're on a foundation of feels right now that are concerning folks. And now you're starting to see some economic data that is a little bit concerning and might be a harbinger of maybe some tougher economic times.
Got it. So did not meet the prediction for it, which means, hey, we're not in as much control. Like the perception is we don't know what's coming. People like stability and consistency / under promise over delivering as opposed to over promising under delivering. And therefore now everybody's saying, oh, okay, could this mean there's something worse?
Yes, that is true. But I think it's worth noting that
Yeah.
the Fed
Yeah.
has been rooting for this.
Correct.
The Fed has signaled this,
Yeah.
and they have said,
Yeah.
we want, wage growth and the number of jobs to slow because, again, this is why this complicated thing, because if wages slow,
Mhm.
wage growth slows, and the number of jobs added slows,
Mhm.
that is a good sign for lowering inflation, which is the Fed's mandate.
Correct.
So through all of these, you can play both sides of this and say, is this a good thing or a bad thing?
Yeah.
But just through the lens of a real estate investor right now, if your focus is on how to get lower interest rates right now, missing our expectation for jobs added is a good thing for lowering bond yields, lowering interest rates.
Interesting. Okay. So we missed our job expectations. All of this environment's out there. I would love to is there anything else that we want to hit on here before we move on to builder sentiment that you're thinking about?
Unemployment. So it's, again, to sprinkle on something else that concerns people.
Yeah.
Unemployment ticked up last
Mhm.
month. It went up to 4.1% for the country from 4%.
Mhm.
Not huge, but again, if you're on top of all of these things that are potentially causing you to have some concern,
Mhm.
you could draw the correlation and say, you know what, I'm going to be a little bit more conservative with my money.
Yeah.
Unemployment went up. We missed our jobs report, tariffs, potential wars, all that stuff. Okay, I'm a little scared. I'm a little bit more scared than I was before.
Yep.
And boom, I'm going to move my money to bonds. That's what's happening.
Got it. So unemployment ticked up, missed the jobs report, CPI. Okay. All right. Summarize the points there of like.
Yeah, this is what happens when money is scared.
Yeah, this is scared
when money is scared, it
Yeah.
moves from the stock market into bonds. Just to simplify it, they move from something more opportunistic to something that's more of a safe haven, and that's what's happening because bond yields. Because people are moving to bonds, the demand for bonds has gone up. Bond yields go down, which is the greatest correlation to our interest rates, and that's why our interest rates have dropped about a half point, even though the Fed had nothing to do with it.
Okay, got it. So now let's talk builder sentiment, right?
Yeah.
So builder sentiment at an all-time low also. That to me is confusing in one way and understandable in another, right? Like I can imagine that builder sentiment when it comes to tariffs and imports and all this trade war stuff that we're talking about, that's got to be highly destabilizing. Interest rates being high has to be destabilizing, but they're lowering. And then, oh, man, I had something that like sounded good to me, right? Like there's also the idea. I forgot.
So it's talking about how at the end of the day, how do we get out of this problem? Home
Oh
price
yeah,
affordability?
we're also super low on supply,
Yeah.
right? Like so, like we've talked about like an affordability crisis, and there's like a super low supply. So like, can you paint a picture? You guys are major builders, right?
Yeah.
Like, can you paint a picture of builder sentiment?
Yeah, I think we can kind of break this down. This is a great opportunity to get a little bit more nuanced because I think it'll make a little bit more sense as we kind of break it down a little bit. So big picture, if you're a builder and you're hearing that there's a 25% tariff on the cost of lumber, it's definitely going to affect your sentiment, right? It's definitely going to affect your forecast on how much you want to build.
Yeah.
Right.
But wouldn't you just like pre-order a whole bunch of lumber right now if you think there's a tariff about to go in place?
Do you know when the tariff's going to go into place?
No, because I guess the tariff hits when that actually crosses the border, not when you purchase it.
Well, I don't know so much about how the tariff actually gets implemented, but I think we've said that the tariff was going to happen, and then we have
Sure.
delayed it.
It's
and
probably
all this
priced
other
in at this
stuff.
point. Yeah.
I don't know.
Yeah,
I mean,
yeah.
I have internal emails of some of our vendors saying, "Hey, we're going to implement this tariff.
Mhm.
We're going to pass along this cost because of this tariff," and then
Yeah.
the email comes the next day and say, never mind." So
Yeah, okay.
it's something to navigate as a builder. You don't really know what your cost of materials is going to be
True.
30 days from now, and that's not good for sentiment of how much you want to build.
Correct.
Got
it.
But the issue of how do we get out of this affordability problem is supply side related.
Yeah.
We need to build more inventory, but it's specific the type of inventory we're talking about.
Yeah.
So when we're talking about builder sentiment surveys, it's talking about builders of single family homes and multifamily and, apartments and all of that good stuff. The supply side is very different on the multifamily side than it is on the single family side. We are way undersupplied on the single family side, which is what we invest in.
Yep.
Right. On the multifamily side, if we remember from the quarterly market update last quarter in Q4 of last year, we looked at what's happening with the supply side of multifamily and apartments in Jacksonville. And a ton of supply was coming on the market in Q4 and Q3 of last year.
Yeah.
On the multifamily side.
Yeah.
And that was actually leading to price declines in the rents on multifamilies.
Yep.
Not on single families,
Yep.
but on multifamilies. So if you're from the lens of a multifamily or apartment builder right now, and you're looking at higher interest rates than you would like, even though they've come down a little bit, and you're looking at tariffs that you may have, you may not have, we're not really sure. And you're in many parts of the country, you're at either equilibrium supply or maybe you're oversupplied. It's very easy to see and sit here and say, "Oh, you know what? My sentiment for building right now, not so high. I'm gonna wait on this a little bit or build minimums rather than maximums in the multifamily space."
Yep.
Now, from the single family space, it's a little bit more nuanced, right? We are undersupplied, but then builders are looking at profitability, and tariffs hurt profitability in some way, shape, or form. We don't know how that's going to play out. Interest rates hurt profitability in one way, shape, or form.
Yep.
Higher interest rates hurt demand. They suppress home buyer demand as well. How long can this continue to go on without that really impacting the number of sales? In a growth market like Jacksonville, you have less to worry about because there's so many people moving here, but in other parts of the country, you can start to see where people are like, well, I don't know if this is the right move or this isn't the right move.
Yeah.
And that would be reflected in a lower sentiment. But overall, that lower builder sentiment is combined of every type of builder, not just single family.
It's as you talk about it, and I'm just like doing the math in the head, and my my head goes to like, man, builders are really stuck in the middle of all of this, right? Like builders really just like the tariff thing is very real, the interest rate thing is really real. At the same time, there's this like golden opportunity of undersupplied market. Like that's got to be a really, really tough place. And then as I was thinking through that and having empathy for it, I was like, you old son of a gun. The single family home build to rent builder that has figured out how to do it in infill lots is the only person that can build with confidence.
Yeah. Yes. I won't say the only person, but yeah, they have.
I'll just explain that, right? Like
Go
I'm
for
just like, I have a friend in Colorado who's doing great. He was building these like really green homes in Colorado, and he is like in the business death spiral right now because he can't sell anything.
Right.
Right. Like, you just said it. Multifamily people just got kicked in the teeth, and they're like, can this really, really work right now? In my head, I'm just like, why can't my friend in Colorado just like rent that stuff? But he's in Denver and it's not going to cover cash flow. And they've already like, they weren't doing it with the plan to do that. So there are already so many in that like turning around to do this doesn't pencil out still.
Yes.
And yet here you guys sit pretty knowing that you can bring a home to market, build it, you can sell it if you want, or you can keep it because it's cash flow positive and it's doing all the things in the single family home investment class. And like, I'm just having this out of body experience of, man, for all the times that I have gushed about your business model, like right now feels like, God damn, like you son of a gun, right? Like that was what happened in my head. I know that's ADD, but like, that's really what just happened in my head.
I feel like I'm reliving my aha moment
Yeah.
with my business partners like 15 years ago.
Yeah.
we had tried to
Yeah.
build and sell on the retail market. We tried high priced homes. We tried, middle income and above and all that other stuff.
Yeah.
And then when you get stuck
Yeah.
holding 20 mortgages where things don't sell
Yeah.
and you can't possibly rent it out to cover the mortgage,
Yeah.
it gets real. You start to not like your business anymore as much at that point. You start to search for an alternative. So whenever it was for us at some point early in the game, we said, we want a model where no matter what comes at us from an interest rate perspective, from a population growth perspective, from this, that, and the other thing, we're going to have a way to survive and thrive. And that's the premise of single family homes in
it's crazy
workforce housing neighborhood in a growth market.
And vertically integrating and owning your own land supply and your own money supply. Like, I'm just like, I have goosebumps, dude.
Yeah.
That's crazy. That's nuts, man. That's really nuts.
So it's like, we talk about this. We talked about this at Summit. That single family homes are constantly just underestimated. Like, everybody thinks like, oh, listen, I'm going to, maybe I'll buy one, but I'm going to really graduate to a really, really stupendous asset class as soon as I can.
Yeah.
And I just don't get it. Like, this is it. Like, this asset class provides so much risk mitigation. It provides significant upside. Like, what else do we need to see? If we look at the data, right, what else do we need to see? We saw how single family rental homes have performed in the really good times. It was the darling asset class when interest rates were really low, right? And it's funny, we call that a really good time. That was COVID, right? Like, a really tough time for us as people. Yeah. But like, from an investment perspective,
I mean, it had Warren Buffett quoting, "I would be buying single family homes during the depths of the Great Recession."
Yes, exactly. Like the toughest of times, it does really well. It has this high floor with upside. Yeah. And you look at the things that can,
and in good times you have like super high home price appreciation because everybody's driving the price up.
Yes, that's true.
Right. Like,
which is largely driven by interest rates.
Which is driven by interest rates.
And population growth.
And people having money and wanting to upgrade their home and whatever.
That was a big part of the COVID run-up. For sure. There was a lot of cash in the system. So it's just like, I love this asset class for what it is. And everybody else, I feel like, is waiting to find the next thing. But it's like we were talking about, like, in the Wizard of Oz. Like, the answer is like right underneath your nose. I was always home. I was always home, right? Like, that's what I feel like with single family rental properties. And
home is where the heart is.
There we go. I don't know.
What is it when she clicks there's no place like home. There's no
Thank
place
you.
like home, but she was always home. Yeah. That makes a lot of sense. Yeah, so that's really interesting, GC. So I mean, I guess if we were to wrap this all up, right? Like, this idea of mortgage rates are going down, which means that it's like a good time to get more cash flow, put in less, have to deposit less in order to have positive cash flow. The world is in uncertain times. Builders aren't really building, which means that the supply demand dynamics are not going to get better, which to me shows that home prices are going to continue to go up, like fundamentally. And people are on the sidelines. They're not going to make big asset classes. People that are renters are going to stay renting. People that are homeowners are going to stay in their homes, kinds of thing. Am I wrong to think that right now, in this state of influx, this dip in mortgage rates that just happened, combined with like all this uncertainty, combined with knowing that this is a phenomenal thing, that like workforce housing, single family homes are a great place to put your money in general. They do well in bad times and well in good times, that taking advantage of like a mortgage dip might be the move, because we're in this like kind of like state of chaos where it might go up or it might go down again?
Yes to what you're saying, but I think it's more than that. I think we just need to understand how beautiful this asset class is and buy into this model. And when folks ask me, is this a good time to buy real estate? My answer every time since we've been doing this show is yes. And it's based on data. It's not just because I have something to sell, right? It's based on data. It's just like you talked about. In tough times, this asset class does very well. In good times, it does even better. Right? Like, there are not other asset classes that I have found that are available to the everyday person that can say that. So I just think that, yes, there is an opportunity right now to get more cash flow and better returns on investment and less out-of-pocket capital today versus there was 2 months ago. Yes, that is true. But more than that, I want people to understand why this model is so beautiful. Why building a better retirement account or accomplishing a big financial outcome for you should be based on a portfolio of single-family rental properties. Because, should our economy go into some tougher times right now, you are going to see this asset class stand out, be resilient, perform consistently well, just like it has in other tough times. It is going to be a great opportunity for you for a very different reason than it was 3 years ago.
Yeah.
But it is still going to be the best risk-adjusted return available for the everyday person. That's why I love it so much.
Yeah, I get it, man. I get it. I love that aha moment of me having this like aha moment and you being like, yeah, this is kind of like what we felt in 2011 or 2010 when you guys went all in on rental properties, man. Like it really, it's hard to deny sitting in the seat for the last 5 years, talking through all the different crazy things that the economy has done and politically, economically, COVID, right? Like oil prices going negative,
Eviction
like
moratoriums.
eviction moratoriums, all this type of stuff. Like I just have such a hard time.
You've seen it all, man. I feel like you've seen like 100 years of real estate investing in 5 years.
I feel like I've been on a roller coaster.
Yeah.
I
see where you're going.
You see where I'm going with this, right?
You're going.
Like, I just feel like I've been on a roller coaster, right? Like, it's been a real roller coaster of emotions throughout all of this. And, it's not easy I am a person that likes to challenge thoughts and likes to do things my own way and just ask my parents, right? But like, it's really hard for me to like pierce through. And I've had tough times in real estate and, like I've listened to people's stories. It's just really hard for me to pierce through any other thought than like, why wouldn't I want somewhere around like 60 to 70% of my like net worth in this bucket that makes so much sense, that's going to give me so many options, that provides this long-term stability, and then do the, like diversify as needed, but like I just there's not much more than I want from it. So it's really cool to just continue to reinforce that, man.
Man, I love this journey that you've been on,
Yeah.
and we've been doing this for 5 years now, and we're still together. We are still coming up with aha moments of like,
sure.
How do we communicate this message of why we love this so much? So I think that's one of the best things for us all to go through together is like, how does this message land a little bit differently than the last time? What's the aha moment? So that's been a real joy for today. And this idea of basing your financial outcomes on something, if you just took the labels of whatever you're investing in off and you took the perceptions of what your friends and family and what the media might say is the right thing to do off of it, and you just looked at the financial aspect of it and the ways that it pays you and the consistency and good times and bad times, it's hard for people not to reach the conclusion that you talked about, which is a significant portion of their investable capital in something like rental properties. Yeah.
All right, GC, I'm pretty pumped for next week, man. Next week is the grand poobah, what we call it, right? Like the big dance, the Q1 JWB Jacksonville Real Estate 2025 market update.
Oh, yes.
I tried to do that as slow as possible.
I thought you were going to go like a little bit like Jim Nance-ish for the big dance, like the March Madness. No,
I just don't, I don't watch college basketball or golf.
Are you going to watch the Gators this year?
Of course I'm going to watch the Gators this year. That's the only time I watch college basketball.
Holy cow. Gators are just tearing it up.
I can't wait. You have been my access to that.
I know.
So I can't wait for the tournament. Like I've only won 2 brackets in my life. It's been the times that the Gators win the championship. Yeah. So I fully expect to win a bracket this year. Little teaser about the real estate about the market update.
Yeah.
I took that line about the roller coaster straight out of my boy's presentation this morning.
Man. I mean, I'm really excited. Pablo and I have talked and shared texts, and I'm like, man, I think this is the best one we've done. I think this is going to be the best one that we've done. I think, man, I hope that when you all come back next week after spending an hour with us, you're going to feel not just that you understand what's going on in the market today here in Jacksonville. You're going to understand how did we get here in a very easy to understand place, and you're going to understand what does this mean for you who are investing in single family rental properties in Jacksonville. And we're going to take on some of those really big notions out there, some of
Yeah.
the big challenging things. Like we're going to talk about inventory. We're going to talk about months of inventory. We're going to talk about rent prices. Are they going up? Are they going down? What are people saying?
Yeah.
We're going to tackle each one of those, bring some data, bring some perspective. And I think you guys are going to really enjoy your hours.
I really liked the nuance that you brought to the soft rental market. I think that that's going to be answer a lot of questions for people. And I'm really into this like market data that as you started presenting, we started teasing out.
Yeah.
Like we've literally been for the last hour and a half messing with ChatGPT on how to visualize this data that GC and I are scheming. So do not miss the Q1 2025 Jacksonville rental market update next week. I know that you're not going to miss it because it's our most attended show. So show up and
bring
be
a
with
friend.
everybody.
We've got, about 85 folks on right now.
Yeah.
If you really love somebody, send them a text and say, go to NYAInsights.com. They can register for free, and then you'll have a friend in the chat.
I'm going to bring a friend. I'm talking to you, Vlad.
All right.
I'm talking to you, Vlad. I was just at a dinner. Sean got engaged. We did this like celebratory dinner.
Oh man, I gotta shoot him a text.
Vlad pulled me aside. He's like, dude, I gotta tell you, I've been listening on the podcast. I've been listening on the podcast. He was like quoting back to me multiple episodes on the podcast. I'm like, dude, why don't you join us live? Vlad, this is for you, buddy.
All right, I love it.
This is for you. Market update. I know you listen to all of them. I hope to see you in the audience next week. You know how to find it because we call it in the call to action on the podcast every single time. To the community that showed up today, 85 plus for an hour in the middle of your workday on a Tuesday so that Gregg can tell me all the things in his mind. I can come to aha moments. He can come to aha moments. You can be part of the aha moments. You can make fun of me for having a senior moment, which I did. Nadeem, I see you. Thanks a lot. I appreciate it. It just never goes underappreciated that you're here. Like taking time to be here with us, being part of this community, and everything it represents is awesome. We'll see you all next week. Until then, tell them, GC.
Don't be average.
See ya.